The silver crash from 121 to $64 was not what you think it was. It was not the end of the bull market. It was not the bubble popping. It was not proof that silver was overvalued. I know that is what the headlines told you. I know that is what your gut felt when you watched your portfolio bleed for days. But I spent the last week pulling data from sources that most retail investors never look at. And what I found completely changed my understanding of what actually happened, because the crash was not caused by people who understand silver selling silver. It was caused by people who were gambling on silver with borrowed money being forced to sell whether they wanted to or not. And once you see the data I am about to show you, you will never look at a silver price crash the same way again. Welcome to the Alex Silverman Official. If this kind of analysis is what you have been missing, hit subscribe. I break down what mainstream financial media will not touch. And drop the word silver to the moon in the comments so I know this community sees what I see. Let me start with something that took me an embarrassingly long time to understand about the silver futures market. And honestly, I think most retail investors have no idea this is how it works. On the COMEX, which is the main silver futures exchange in the United States, some traders control their entire silver position with just 5 cents of their own capital and 95 cents borrowed. Read that again. 5% of their own money, 95% borrowed. That is roughly 19 times leverage. To put that in terms anyone can understand, imagine you have $1,000. With 19 times leverage, you are controlling a $19,000 silver position. If silver goes up 5%, you just doubled your money. Sounds great, right? But if silver goes down 5%, your entire $1,000 is gone, wiped out. And here is the part that matters. When that happens, you do not get to sit there and wait for a recovery. The exchange forces you out. It is called a margin call. And when enough traders get margin called at the same time, their forced selling pushes the price down further, which triggers more margin calls on other traders, which forces more selling, which pushes the price down even more. It is a cascade, a domino effect, a mechanical waterfall of liquidation that has absolutely nothing to do with whether silver is actually worth less than it was yesterday. That is exactly what happened in the crash from 121 to 64. And I want to make sure you really understand how violent this process is because the numbers are staggering. When margins went from 5% to 8%, some traders immediately ran into financial trouble and were forced to sell. Then margins moved to 11%, more forced selling, then 15% more liquidation, then 18%. By that point, anyone who had been far too aggressive with leverage was completely wiped out. Each wave of margin increases created a new wave of forced sellers. And each wave of forced sellers pushed the price lower, which made the next wave of margin calls even more devastating. It is like dominoes falling in a circle. Each one knocks down the next, and the process feeds on itself until there is no one left to knock down. Think about it this way. Imagine a crowded theater where someone yells fire. Everyone rushes for the exit at once. They are not leaving because the movie is bad. They are leaving because everyone else is leaving and the doors are narrow. The movie is still playing, the theater is still standing, but the stampede makes it look like the entire building is collapsing. That is what happened to silver. The movie, which is the fundamental supply and demand picture, never changed. The theater, which is the physical market, is still standing. It was just a stampede of overleveraged speculators all trying to fit through the same exit at the same time. Now, let me show you the proof because I am not asking you to take my word for it. I pulled the open interest data from COMEX Silver Futures, and the chart tells the entire story. Open interest is the total number of outstanding futures contracts. It tells you how many positions are currently active in the market. When silver was peaking near its highs, open interest hit approximately 176,000 contracts. That was the maximum number of traders with active positions. Fast forward to after the crash. Open interest has dropped to roughly 137,000 contracts. That means approximately 39,000 contracts were closed during the decline. 39,000 positions that no longer exist. Those were not long-term investors commonly deciding to take profits. Those were leveraged speculators being forced out by margin calls. And here is why that is incredibly bullish. When the weak hands leave, the strong hands remain. The people still holding silver futures right now are the ones who could afford the volatility, the ones with real capital behind their positions who are not going to panic sell on the next 5% dip. The market just cleaned itself, and a clean market is a launch pad. I also want you to notice something specific about where many of these speculators exited. A large number of them closed their positions around the $50 level. And that makes sense when you think about it. $50 was the peak in 1980. $50 was the peak in 2011. For 50 years, $50 was the ceiling. So when silver came back down through that level during the crash, anyone who had been watching silver for decades saw it as a natural exit point. They locked in strong profits and stepped aside. But here's the important part. If silver now forms a higher low above $50 or $60 or $70, those same traders have every reason to step back in. They took profits at a level that made sense to them. And if silver proves that the old ceiling has become the new floor, they become buyers again on the next move higher. That is not a bearish setup. That is a massive pool of potential buying power waiting on the sidelines. But I did not stop there because I wanted to know if this was just an American phenomenon or if the same thing happened globally. So I pulled the open interest data from China's silver futures market. And the chart shows the exact same pattern, the exact same spike in open interest during the rally, and the exact same collapse in open interest during the crash. This was not one exchange having a bad day. This was a global flush of leverage speculators happening simultaneously on two continents. When I saw both charts side by side, I knew this crash was mechanical, not fundamental. The gamblers got wiped out. The silver did not change. The demand did not change. The supply deficit did not change. Only the leverage changed. Now, here is where my research took a turn that genuinely surprised me because I wanted to look beyond the futures market. I wanted to see what was happening in the physical silver market, the real market where actual metal changes hands between professionals who use silver every single day. And what I found made the futures crash look almost irrelevant. I pulled the lease rate data from the London silver market. Now, if you have never heard of lease rates, let me explain because this is critical and almost nobody talks about it. London is the largest trading hub in the world for physical silver. Professional participants there do not just buy and sell silver, they also lend it to each other. This happens constantly. One participant needs to deliver silver next week but does not have it yet. Another participant has silver sitting in a vault that will not be needed for a month, so they lend it. The rate they charge for this loan is the lease rate. In a normal healthy market with plenty of physical silver available, the 1-mon lease rate hovers around 0%. Sometimes slightly positive, sometimes slightly negative. Anything above 1% is already considered stress. Do you want to know what the lease rate is right now? 4.5%. Let that number sink in. 4.5% for a 1-mon silver loan. I went back through the data. In 2023 and 2024, the lease rate was flat at 0. Completely calm, no stress, no tightness, and now it is at 4.5%. That is not a red flag. That is a 5-alarm fire. It is the physical silver market screaming at you that there is not enough metal to go around. While the futures market was crashing and every headline was telling you silver is done, the professionals in London who actually handled the metal were paying historically extreme rates just to borrow it for 30 days. Do you understand the disconnect? The paper price says silver is crashing. The physical market says we cannot get enough of it. One of these is lying. And I can tell you it is not the professionals who actually need the metal. But wait, there is another data point that hit me even harder. And this is the one that I genuinely think most investors, even experienced ones, have never looked at. It is called the 1-year silver swap rate minus US interest rates. I know that sounds complicated, but stay with me because I am going to explain it in the simplest way possible. In a normal market, if you buy silver today and agree to sell it in 1 year, the price you sell it at is slightly higher than today's price. Why? Because holding silver for a year costs money. Storage, insurance, opportunity cost on your capital, that cost gets built into the forward price. This is called contango, and it means everything is fine. There's plenty of silver, no rush, no urgency. Take your time. Now, when this relationship flips, when the price for silver delivered today becomes higher than the price for silver delivered in a year, that is called backwardation. And it is deeply abnormal for a storable commodity like silver. It means buyers are so desperate for physical metal right now that they are willing to pay a premium just to get it immediately instead of waiting. They are literally saying, take my silver today, and I will pay you extra because I need it now and I cannot wait. And right now we are not just in backwardation, we are in extreme backwardation. The deepest level I can find in modern data. The 1-year silver swap minus US interest rates is sitting at approximately 3.5. That number should be positive. It is deeply negative. The physical market is not whispering, it is screaming. Now let me connect this to something I covered in my previous videos because this is where all the threads come together. I have been tracking the inventory data at COMEX and in Shanghai for weeks, and both charts continue to decline. Let me walk you through exactly what I see. The COMEX silver inventory chart shows a consistent staircase pattern downward. Every week, less metal. Every month, less metal. The current registered inventory has dropped to its lowest level in months, down from roughly double that amount just 6 months ago. The metal is leaving and it is not coming back. No reversal, no stabilization, just a steady, relentless decline. The Shanghai inventory chart shows the same thing. From a peak of over 1.2 million, the number has collapsed to approximately 350,000. I showed you in my first video on this channel how the SHF vaults were draining at 42 tons per week. That drain has not stopped. If anything, it has intensified. So let me ask you a question. If silver just crashed 50% and the bull market is over, why are inventories still falling? If the demand has dried up, why is there less metal in the vaults today than there was before the crash? If nobody wants silver anymore, why are lease rates in London at levels we have never seen before? If the trade is dead, why is the physical market in the most extreme backwardation in modern history? The answer is obvious. The crash was not about demand. The crash was about leverage. Let me paint you a picture of what actually happened step by step because I think the sequence matters. Step 1, silver rallied from $37 to $121 over several months. During that rally, speculators piled into COMEX futures with massive leverage, some with as little as 5% of their own capital. Open interest surged to 176,000 contracts. Step 2, volatility increased as the price moved faster. When volatility increases, exchanges raise margin requirements. This is not manipulation. This is a standard mechanical process designed to reduce systemic risk. Margins went from 5% to 8%, then 11%, then 15%, then 18%. Step 3, each margin increase forced the most leveraged traders to either deposit more capital or close their positions. Most of them could not deposit more, so they sold. Their selling pushed the price down. The lower price triggered margin calls on other traders who had slightly more cushion. They sold too, and the cascade began. Step 4. In a matter of days, silver went from 121 to 64. 39,000 futures contracts were liquidated. The reckless cowboys were flushed out of the market. Not because silver became worthless, because they were gambling with borrowed money and the music stopped. Step 5, and this is where we are right now. The speculators are gone. Open interest is at its lowest level in months. The market is now held by participants with real capital, real conviction, and real reasons to own silver. And every single indicator in the physical market, lease rates, backwardation, inventory levels is telling you that the actual metal is more scarce and more in demand than it was before the crash. Think about what that means. The price is lower, but the physical tightness is higher. That is like a coiled spring. The further you push it down while the underlying pressure builds, the more violent the snapback when it releases. And there is something about commodity markets that most people who come from the stock market do not understand. In equities, when prices crash, demand usually dries up. People get scared. They stop buying. They wait. Commodities work differently. In commodities, rising prices often increase urgency rather than fear. Buyers worry about securing supply at even higher prices tomorrow. They rush to buy, not sell. And when prices crash due to a technical event like a leverage flush, the physical buyers do not disappear. They accelerate because, to them, cheaper silver is not a warning sign. It is a discount. The industrial buyer who needs silver for solar panels does not care about RSI charts. The mint that needs silver for coins does not check futures open interest before placing an order. They see lower prices and they buy more. That is exactly what the inventory data confirms. The price crashed and the metal kept leaving the vaults. The physical buyers treated the crash as a sale, and they are still buying. Now I want to address something directly to 3 groups of people watching this video. If you sold during the crash, I understand that kind of move is terrifying, especially if you had a significant position. But I want you to look at the lease rate chart and the backwardation chart and ask yourself one question. Does a market that is this tight look like a market that is done going up? Or does it look like a market where the paper price temporarily disconnected from physical reality? If you held through the crash, the data says you made the right call. Not because the price went back up the next day, but because the structural picture underneath the price never broke. Inventories kept falling, lease rates kept climbing, backwardation kept deepening. The foundation of the bull market is not the price on your screen, it is the physical tightness underneath it. And that tightness has only gotten more extreme since the crash. If you have been watching from the sidelines, this is the data you need to make your decision. I am not going to tell you what to do, but I will tell you what the numbers say. The speculators who drove the crash are gone. The leverage that created the waterfall has been cleaned out. And the physical market is tighter than it has been at any point in this entire bull cycle. Here is what I expect to happen next, based on what the data is showing me. And I want to be clear that these are my observations, not guarantees. The area around $70 has a strong probability of becoming the new structural floor for silver. The reason is simple. The mechanism that pushed prices sharply lower, which was forced liquidation of leveraged futures positions, has largely been exhausted. Open interest has already collapsed. There are not enough leveraged speculators left to create another cascade of that magnitude. At the same time, the forces that push prices higher, Physical demand exceeding available supply, declining inventories, extreme backwardation, record lease rates all remain firmly in place. The sellers have been flushed, the buyers are still there, and the metal is still disappearing from the vaults. Here is something you can verify yourself right now. Google Silver Lease Rate London. Look at the number. If it is still above 4%, you are looking at a market that is in extreme physical stress. Now Google Silver Backwardation 2026. See what comes up, because when you verify this data on a screen that is not mine, it hits differently. These are not opinion pieces, these are market rates set by actual transactions between professional participants who collectively trade billions of dollars worth of silver every month. They cannot be faked. They cannot be manipulated by a YouTube video or a social media post. They are the raw, unfiltered voice of the physical silver market. And right now, that voice is saying one thing very clearly: there is not enough silver. I also want you to understand how unusual this combination of signals is. I have been studying commodity markets for years, and I cannot find another period where open interest collapsed while lease rates spiked, while backwardation deepened, while inventories declined all at the same time. Usually you get one or two of these. Maybe a spike in lease rates during a temporary squeeze, maybe declining inventories during a demand surge, but all four simultaneously during a price crash. That is not a market that is breaking down. That is a market that is coiling. And remember something I mentioned in my previous videos. Both the United States and China have taken extraordinary policy actions around silver in recent months. China implemented export controls on January 1st, 2026, restricting silver exports to just 44 approved companies and effectively trapping 60 to 70% of global refined silver supply inside its borders. The United States added silver to its list of critical minerals in November 2025. Governments do not designate a commodity as critical and strategic if it is abundant and unimportant. They do it because it is scarce and essential. Both of the world's largest economies are now treating silver as a strategic resource, and the inventories on their exchanges are declining simultaneously. That is not a coincidence. That is a signal. Now I need to be honest with you about risks, because I never want to present one side of a trade without acknowledging the other. I hold silver. I have skin in this game. And there are scenarios where this thesis faces challenges. If lease rates in London fall back towards zero, that would signal that the physical tightness is easing. If the extreme backwardation normalizes and the market returns to contango, that would suggest the urgency for immediate physical delivery has faded. If inventories at COMEX and Shanghai begin to rise meaningfully, that would indicate new supply is entering the system. And over the longer term, higher silver prices will incentivize industrial users to find substitutes or efficiency gains, and increased copper production could bring additional silver supply to market, since silver is often a byproduct of copper mining. I am watching all of these indicators every single week, and if the data changes, my view will change with it. But right now, today, none of those conditions are present. Lease rates remain extreme, backwardation is deep, inventories continue to fall, the data has not changed, only the price changed, and the price changed because of leverage, not fundamentals. There is also something important happening in silver mining stocks that I want to flag for this community. Mining stocks are still priced as if the crash proves the bull market is over. They are trading at valuations that assume silver at $50 is as good as it gets, and that every parabolic move ends in a permanent collapse. But if I am right that $70 becomes the new floor, and the physical market remains this tight, mining stocks have not yet priced in the new reality. They are still stuck in the old one. And when the market realizes that the floor has moved up by 40% from the old $50 ceiling, the repricing in miners could be violent in a good way. Let me bring this full circle. I want you to think about what you just heard in the context of what I have shown you in my previous videos. In my first video, I showed you that silver vaults in Shanghai, New York, and London are all draining simultaneously for the first time in modern history. In my second video, I showed you the 5 to 7 month surge pattern that has produced triple-digit percentage gains twice before, and that we are currently in month 2 of that pattern, and now in this video, I have shown you why the crash that scared everyone was not a breakdown in the bull case. It was a leverage flush that left the physical market even tighter than before. The paper price crashed, the physical market got tighter, the speculators left, the strong hands stayed, the inventories kept falling, the lease rates kept climbing, the backwardation kept deepening. Everything that matters for the long-term case got stronger during the crash, not weaker. The only thing that got weaker was the confidence of people who do not look at this data. 5 years from now, people will study this crash as a textbook example of how leveraged futures markets can temporarily disconnect from physical reality. They will point to the lease rate chart and the backwardation chart, and they will say it was obvious in hindsight that the crash was a mechanical event, not a fundamental one, that the strong hands who held through it were rewarded, and that the real signal was not the price falling. The real signal was the physical market refusing to confirm the decline. I will keep tracking every data point, every lease rate update, every inventory report, every backwardation reading, and I will be here to walk you through what they mean as this story continues to unfold. If this video changed how you see the silver crash, drop what do you think in the comments. Send this to one person who panicked and sold during the crash. They need to see this data before they make their next decision. The crash was not the end of the story. It was the reset before the next chapter. The speculators are gone. The metal is still leaving the vaults, and the physical market has never been this tight. The question is not whether silver recovers. The question is whether you are positioned when it does. This is the hidden economy. I will see you in the next.